Great. Coffee with Kristel on this Thursday. Few delays in getting started, but welcome. And I'm going to take my first sip in my cappuccino homemade. Very refreshing, that hot, warm sip of coffee. So today I want to talk about rates. I usually don't talk about mortgage rates because forecasting to me is like, although my name is Kristel, it's like, do I have a crystal ball of what things are going to look like? And yes, there are some factors, there are ways that an analyst can come up with how the rates are going to be. But in the last few years, the forecasting were not as accurate because things have been thrown off very much in this market. But I do want to share my screen and go over some forecasts that were provided by different sources. So we can talk about that, but also talk about a conversation a client of mine received on the 2-1 buy down. So it is not very colorful. It's very bland here where you can see forecasts because numbers are numbers. But according to the Yahoo Finance, 2025, 2027 mortgage rates are going to stay in the mid to upper 6% range. So by 2027, you're going to start to see a decline of about 6.2 to 6.4. Now, keep in mind, this is the on average. Um, this is not necessarily a specific program. It's going to be more actually your conventional and FHA type of mortgage. When we're talking about specialty financing, rates are totally different. But the 10-year treasury yield is the one that's really used to um, predict or have calculations for the interest rates. Now, I'm not going over APR. I'm not quoting interest rates. Just this is just research done for forecasts of rates now in 20 through 2029. And the reason I want to talk about this is clients are asking, is it best for me to buy now? Should I buy in the future? Should I wait? And all this. So you want to make a decision according to where you are. If you are currently renting, it's always a great time to buy, right? Because you are currently just paying rent to a landlord. If you currently own a house and you just want to have a bigger house, just to have a bigger house, you may stay with what you have because the terms may not be as favorable based on what you currently have. And if you want to be an investor, the market based on how it's moving, you get to make a decision according to your story, according to where you are in your needs. So coming back to the forecast, Fannie Mae July 2025 outlook rates end of 2025 6.4, end of 2026 6.0. Reuters poll 2025. I know you can read, but I just want to kind of show you they're all in the sixes. Mortgage rate 6.98. Currently, rates are in the mid 6%. 2026 about 6.3. 2027 6.29. Real wealth market insight 2025, 2027, 6.7, and even potentially 7.5. So remain high perspective to what we had seen last year. 2020, 2020 potential drop more manageable in the 5.5. That would be the sweet spot, right? It's 5.5 rates in the fives, which I am able to quote those rates on certain programs. So and also doing permanent rate buy down. Now, when you see this, ask yourself, well, if rates are going to be in the sixes, and I'm thinking I'm going to wait for 2026 to make a change, why? Because remember also when you are going to have a rate drops, people are going to jump into the market and they're going to be ready to make their offers. Now you have more competition. What people are doing right now, the clients that I'm seeing making offers, they have more buying power because now they can ask for seller concession that can be used towards the bottom line of the purchase, of their closing costs, the funds to bring to closing, or they can also buy the rate down or do a combination of both. So you want to really set yourself for success by purchasing now if you're finding the right property. Of course, it has to be within not only just your budget, but um, making sometimes adjustments because if you're going from renting, I had a client I spoke to yesterday, currently paying rent of 3,100. and now she's going to buy a house and it's going to be about the same. That is totally visible, right? It's like, hey, I'm paying this in mortgage, I'm in rent, I'm going to buy another one in buy my house now and pay the same amount. But she's in order to do that, she's having to put over $80,000 down to bring the mortgage to that amount, the mortgage payment to that less than 3,000 to be able to not only qualify but stay within her budget. So think about your investment. Get with your financial advisor. Does it make sense for me to take that 80,000 that's giving me an earning right now to go ahead and buy a property, or what should I do? So it's not just a conversation of rate, it's a conversation with your financial advisor, depending on your age, what makes sense based on your long-term goal with your income. Are you going to be retiring? So this conversation is not just mortgage rates, it's not just a payment, it's your lifestyle. It's where are you aiming to be in the next 5 years? We're looking at the rate 5 years, but what is your goal? What is your intention? I also want to share that like I mentioned about the buy down, I want to have a conversation on. I have a client who received this email for a 120 buy down. It's a very nice email explaining the difference. If the start rate for 30-year fixed loan is 6.5, then the rate would be 5.5 the first year starting. The second year, the rate defaults back to 6.5 for the remainder of the loan. So for 30-year loan, you basically only have 5.5 for the first year. The cost to buy the rate down, according to this person's email, is 0.85 of the loan amount. So you take your loan amount, you multiply that. Basically, if it's a $300,000 loan, you under $3,000 to buy the rate down to save monthly for 12 months, right? So you want to calculate how much am I saving? How much am I having to pay up front? Even if the seller is paying for it, is it best for me to take that money and apply it somewhere else, or does it make sense? Now, for the 2-1 buy down, the rate is lowered by 2%. So it's 4.5 the first year, then it goes to 5.5 the second year, and then it defaults to 6.5. Both options, you still have to qualify with the rate of 6.5, the actual permanent rate. So it doesn't help you qualifying for greater house. It just helps you with your budget the first year or the second year. So with the 6.5 start rate, then the third year you remain for that interest rate. The cost for this, according to this email to my client, as they were shopping around, actually, no, they were not shopping around. They made an offer on a property. And the listing agent, so listen up, my agents also, when he said, well, I came with an offer, and you take the risk of taking your property off the market, and you don't really know if your clients qualify. So that realtor said, in order for me to entertain your offer, my loan officer needs to have a conversation with your clients. And I've always said that to realtors. I can always be an option to double check. Yes, go forward. This seems like a great deal. Yes, it gives me an opportunity to offer to the client something, because that's what they're doing right now, offering their perspective and hopefully win the deal as well. But I had, fortunately, conversation with my clients ahead of time about those headlines of buy downs, and to be careful because he is on an income that's not going to go up. So you want to talk about all this. And I do this talk with the clients up front because I know what's being dingled in front of the clients to say, hey, at 4.5, I would love to do that. And then they get the surprise, by the way, it costs 2.5% of the loan. Is it better to use that money to buy the rate permanently and you have peace of mind? More so because we know what the forecast is going to be when we're being told, oh, you'll be able to refinance. Okay, that is true. But will it make sense? Would you be able to, mostly if you are at a maximum loan of like 97% financing, how much equity do you have to be able to refinance and lower your current mortgage rate? So all those are important factors. Even if you don't understand everything of it, it seems overwhelming. Definitely take time to understand some of the basic numbers. How much am I truly saving? How long will it take for me to break even? And really, are the rates expected to get to that? And you can't really leave off expectations. You have to know the facts. And the fact is, your rate and your mortgage payment is going to go up after 12 months and then the 24th months. So the buy down, according to this email, that's two things. It kicks um the can down the road. I don't really speak this way. That's why I was like, huh? So if you saw an upside in your job, so for instance, if this client is not really expecting a raise, it's just going to be a, you know, 2% raise, very something minimum that's not going to really help him in the future, then that might not be the best thing to do. But if you're expecting a raise, which by the way, even large corporations are actually taking away bonuses, are taking away raises because the market is in a tough spot. So for somebody who has expectation of, well, my spouse is going to be working, there'll be extra income, or I'm going to get a raise, that makes sense. You are getting yourself time to adjust to that mortgage payment. The second thing, according to this email, it's it buys you your rate down. It buys you time if the rates go down, but we just saw it might not really make a difference. Remember, at the beginning of the term of your loan, your principal balance is not, unless you would have been extra money deposits towards your principal, you're not going to be at a much lower principal reduction from when you initially financed. So your savings are not going to be $500 automatically, right? It's not refinancing is just going to save everything. No. So you really want to look at those numbers. So it also says if they go down, you can refinance into a lower rate and afford an affordable mortgage long term. The cool thing is an unused prepaid interest gets applied to the principal balance payoff if you refinance before the rate adjusts back to the original start rate. So that is an advantage there. So definitely, I am not going to knock down and say do not do a 2-1 buy down. I do say though, it is not my favorite because a lot of times, mostly for first-time buyers, they love the idea that they start with a lower interest rate, but new construction or adjustment of the escrow, they now have a payment adjustment because your escrow go up and they call me up and say, um, Kristel, my mortgage payment went up. I'm like, nope, you have a 30-year mortgage. Your escrow went up. So that's why insurance or taxes can move and make an adjustment to your payment. Now you have a new adjustment too, which is your rate went up 1 point because you did a 2-1 buy down. So I don't necessarily advocate for the 2-1 buy down. I'm not saying it is wrong. I'm just saying sometimes people forget that that adjustment is going to take place and they don't adjust their budget for when it goes up the following year, or they were not expecting a change in their income necessarily to say now it's going to be easier for me to get to that jump. So be very careful when you're doing a 2-1 buy down. I think I'm also more of an advocate of speaking about this because I was part of I was in the market 2020, been in the market for 25 years. So that was 2008 when I was doing interest only loans, adjustable mortgage rates, and seeing how in 2008, 2009, I help clients get qualified for those new constructions and yes, get them into the house and then they ended up losing their home. So my goal is for you to keep your house, being able to afford it, and not just jump into something and then regret it. Now, we can only make informed decisions and do the best with what we have. And that's what I want to share with you. It is very important to understand the dynamic of how the rates are going to potentially change or not change, as well as the buy down. Now, I do offer a lot more of the permanent buy down, so take that interest seller concession and go ahead and buy the rate down, or have my grant program for the clients to qualify. We can use that money to go ahead and get your rates in the fives if it makes sense. Again, we want to also look at, does it make sense? Sometimes it still doesn't make sense to the numbers to go ahead and pay so much upfront because it might take longer to recuperate the money. But some clients have said, I still want to go ahead and do it because I feel I want to buy that house and this is what feels most comfortable for me to pay monthly. So we need to talk about rates like we just did, and then the buy down. Now, my next topic is self-employed. And self-employed can be somebody who has a full-time job. So I have a client right now, Shayla. Shayla has a full-time job, and that full-time job is has overtime, but because she just started 4 months ago and she's not in the same line of work, I can only use her 40 hours. But she says, for Kristel, I also still have my 1099 job, which is basically just self-employment income. Now, technically, to be able to use two jobs, so basically her 1099 that she's had for, don't remember if it's over 5 years, but she's had for a while. But then she has this new job, which is only for 4 months. I can only use one of the two, either the average of 1099 or the 40 hours, which the 40 hours is really what I'm going to be using. So I can't really use that second job because she doesn't have a 2-year history of having two jobs, 24 months, right? But I do have a program that is set up more as a lease purchase. It's a non-traditional loan, and we will actually take the two jobs because this is specifically to help clients who are going to go ahead and continue on the path of having both jobs, but we can't in traditional loans, FHA conventional, use this income because there isn't a history of 2 years. This program helps those clients who have the income, the history, even if it's just 6 months or 3 months, but not long enough for your traditional. So we'll do a lease purchase, and it is, we definitely will need to dive in to really explain how this program works, but it's a way to buy your property, have this entity finance it for you for 3 years. You can keep that loan, don't have to refinance, but you have a 3-year prepayment penalty. So that program gives you 3 years to really work on getting ready for traditional loan financing. So now have the 2-year history of employment. Minimum credit score in general for this program when you're self-employed is going to be a 660. They have other credit score that are lower, but it's a different structure. So just want to talk about that general self-employed program, which uses a lease purchase, and you move into your house. Now, another reason why I use this program is self-employed who do not report enough on their taxes. So again, you go to your Schedule C, you go to line 31, you see how much you report. It is not the gross. It is not all your money received. It's going to be your net profit. FHA will require 2 years average of this income. Conventional, if you've had this company or been working 1099 for a period of time, normally it would be about 5 years. If there's a history between Fannie Mae, Freddie Mac, so there are some fine prints there. Then we could take 1 year, so your most recent year. Often though, still, because of all the write-off, clients are not able to qualify to be able to purchase the property that they're looking for. So I was speaking with a client yesterday. Her and her husband are both self-employed, and when she looked at the taxes, like, really? That's how much I'm reporting? Because very often they don't pay attention that the accountant is writing off so much. So please do pay attention to your taxes. It is not necessarily wrong. You're using all the loopholes and all the ways that the IRS is allowing you to have deductions. But when you're ready to go ahead and purchase a house or do financing, well, then we may have to go to alternative programs like the one I just mentioned. Then the traditional programs that are traditional, what we call non-QM, but are not this program that the special judge shared about. I don't want to say the name, but at the same time, it's like compartmental. So there is the lease purchase, which is very specialty, non-traditional. And then we have what most lenders will have, which is your bank statement loan, your profit and loss statement type of loan. Those programs still require 10% down. So you're not income rich as far as in documentation. You'll have to have compensating factors, which are going to be your assets, so savings. And then very often you need to have even your monthly payment as reserve. Different investors have different requirements based on their appetite. There are programs that require a 660 credit score, but now you have to put maybe 20% down. You have the ones with over 700 credit score, and then you have to put maybe 10% down. I do have one of my most recent, and who knows, there might be even more that can offer more aggressive options, but with a 680 credit score, instead of the 620, 640 usually looked for by the investor. I do have a bank statement program with a 680 credit score, putting 10% down, but you do need to have 12 months reserve. So it shows that you have money saved on top of how much you're going to be putting down. That can be in the form of retirement account. Doesn't necessarily have to be your liquid assets from your business account or your personal account. So those are the topics I wanted to cover for our self-employed. And I do have another program that is very common now, which is called the DSCR. Just want to go ahead and explain that one. Again, that is very much for those who are self-employed, those who are not even self-employed, but they want to use the property cash flow to be able to qualify for the property. So that's called a DSCR program. There are so many categories based on the credit score, how much you're putting down. Very often those programs will be a 15% to 20% because they're investor loans. So investors very often need those type of down payment. There are some private investors who offer lower down payment. I've even seen like 10%. But then that's more of my hard money loan type financing with experience. So get your first one, right? I do have, even if you're first time home buyer or if this is your first investment, putting 20% down. Again, there might be some more aggressive when we do homework when I do homework and I say I'll research more investors according to your situation because you need to have a strong credit score. The lower you're putting down, you need to have even more reserve. So let's book a call. Let's connect. Let's see what your situation is. Take advantage of what's positive right now. Not in the investor mindset. It's positive the fact that there are more homes on the market. That means you can negotiate more. Yes, it's not the best for the market in general, but take advantage of the opportunities. If your home's on the market for longer, that means that at some point the seller is going to either listen to their agent and said, you are not pricing the house right, or they will be taken off the market because we're not looking to sell the house. They're just trying to you're not eager, not looking, but not as eager to sell the house. So you might be facing a seller who is going through a divorce and they have to sell the house according to their terms of their agreement. You might be coming across a client or a seller who they inherited the property and they don't want to put the money. I have a client who's working on that right now, who is really asking for high top money for his property. The property looked like it was ready for just go ahead and fresh paint and carpet and put it back on the market. Unfortunately, no. A contractor walked it through the house with the buyer and said the investor and said this property is going to need about $40,000 in repairs. So always get your contractor or your home inspector when you're doing those deals. Don't just use your naked eye and say, oh, this is awesome. I've had clients even in Louisiana who walked away after doing inspections to properties because it needed a lot more repairs than they thought it would be. The cost of material is more too, and you have to also think about your time to fix the property before you put it back on the market, how long it's going to get to take to get your permit. So all those come into play when you're doing those type of investment properties that are needing some fixing. Yeah, those are the topics I wanted to share. So thank you for joining me for Coffee with Kristel. I am also open to having collaboration on this time. If there is, we still want to talk specific to mortgage, not opening it up to general conversations yet, but really mortgage bringing value. So that can be a friend of mine I'm working with getting conversation on mortgage insurance versus life insurance. I have a few clients who are self-employed and don't necessarily have the coverage that they need and one is going through leukemia, another one is had a work accident and don't have insurance, so they're having to use their savings and use GoFundMe to help them. So I will be bringing in someone to talk about this or do myself some research and provide to you. I don't like to talk about programs or situations that are outside of my expertise. So that's why I've asked my friend to join me into this conversation. So that will be Coffee with Kristel pretty soon. And any other topic that's very helpful for mortgage questions, programs, or even real estate like interest rates, even if it's just to stay alert about what's going on. Other things that I offer for free, definitely a chat with Kristel, so you can go on my Calendly. So it's Calendly. You can put Calendly, I think, and just put my name, Kristel, kind of, and it will should bring up my information. But I can definitely send you my link to book a time with me. Let's talk about your situation. I do not pressure you to buy now. It's let's get you ready for home ownership. I'm going to be starting back my webinars pretty soon. It's going to be about investors, or self-employed. And then if you are currently owning a house and you would like to keep up with what your property value is doing, how the market is in your area, let me know. I have a free home report that gets sent to you monthly. No actions to take except to when from time to time, like you may be checking your 401k and some of your accounts of your assets, you check into how is the market doing. For realtors, I have my list report, which is a free service to you. You can connect your clients on home report as well, so they can get this report for free. That's it. Awesome. Well, thank you again for joining me and see you. Oh, can't really see the coffee. Where's my coffee? Oh, I had to put it in front of me, not to the side, Kristel. There you go. Coffee or Kristel. Happy Thursday.